Contingencies and commitments. We would be covering what contingencies are, recognition and measurement of gain contingencies, and loss contingencies, and finally premiums and warranties. Contingencies are potential future losses, potential future gains that depend on the occurrence of some uncertain event. Like when you talk about loss contingencies, these are the contingencies that are basically potential future losses, and these losses depend on the occurrence of some events. Like for example, collectibility of receivables. We have sold goods worth $100,000 to X, right? So what if X defaults? So for this we create an allowance for credit losses. So collectibility of receivables, your customers going bad, they don't pay you, is a loss contingency. Similarly, obligations regarding product warranties, like we have sold goods against which we are most likely to pay $50,000 in warranty cost, right? So this probable loss under warranties is a loss contingency. Risk of loss of property by fire, explosion, or other hazards. Yes, a factory might incur losses from fire if it's not insured. Threat of expropriation of assets. Like a company is operating abroad and it faces the threat that its plants and machineries, they may be seized by the host government. Pending or threatened litigation. Let's say one of our employees got seriously injured while on work and he believes that he is injured because the company did not provide him the safety gadgets or safety gear. So he's asking for $1 million compensation. So this lawsuit that claims $1 million in damages against the company, that's a loss contingency. Actual and possible claims and assessment. For example, a customer sues us for, let's say, $500,000 over some case that maybe he says that we have delivered him the defective product, so he's now claiming a compensation of about nearly $500,000. Then risk of loss from catastrophes assumed by the property and casualty insurance companies. These are the insurance coverages that we obtain from insurance companies for fire, threat, hurricanes, earthquakes, so on and so forth. Guarantees of indebtedness of others, like let's say we have given a guarantee to one of our subsidiaries that in case our subsidiary, we are the parent incorporated and another company is subsidiary incorporated. So subsidiary has taken a loan of $1 million, let's say, and we have guaranteed that subsidiary will honor the payments. If subsidiary fails, we might be liable, right? So a probable loss if the subsidiary fails to pay. Obligations of commercial banks. Let's say we are a contractor and we request the bank and bank issues us a $1 million standby letter of credit facility. Agreement to repurchase receivables, like we sell $500,000 in invoices to a factoring company, but we agree to repurchase any uncollected amount, so we may be liable for that. Environmental damages, maybe our company might be required to pay a certain amount of money if there is an oil spill. So all these are loss contingencies, means probable losses whose occurrence depends upon some future event. Likewise, gain contingencies, these are potential benefits, future benefits that depend on the occurrence of some uncertain event. For example, expected favorable settlement from a pending court case. Consider we sue our supplier for breach of contract and we expect to win $1 million. So this is a potential gain, but it is not recorded in the financial statement because the case hasn't been resolved. Possible refunds regarding tax disputes. Let's say we have been given tax penalty by the tax authority, IRS. So we challenge this tax penalty in the court of law, believing that we are wrongfully imposed this penalty. So if we expect to get this amount refunded, it is considered a gain contingency. So what do we do with this gain contingencies like these we discussed previously? So these contingencies, they are future potential gains, but they are uncertain. They depend upon some uncertain future event. So these gains, they are not recorded in the financial statements unless they are fully realized, means you are certain, or maybe you have received cash, right? So gain contingencies are not recognized unless they are realized. However, loss contingencies in certain cases need to be recognized in the financial statement. So please remember, gain contingencies are not recorded, not recognized in the income statement or anywhere in the balance sheet. But in some cases, if a gain contingency is probable, then we may disclose it in the financial statements. However, gain contingencies are not recognized income unless they are fully realized or we are virtually certain that that's there. So just the examples we were discussing, we are expecting an amount of $2 million against a lawsuit against our supplier, but the final verdict is pending. So we may disclose it in the notes, but we cannot recognize it in the financial statement. Similarly, the example we discussed in this case, that we believe that we are entitled to a $500,000 tax refund after disputing tax charges, but this is only disclosed in the notes if it's confirmed, but we will only recognize it as income when it is actually received or realized. Recognition and measurement of loss contingencies. As we have discussed, loss contingencies are the possible future losses depending on uncertain events. And let's see how they are treated. What if an event is probable, likely to occur? If an event is probable, that is likely to occur, this means the loss is very likely to happen. So what we do in this case, we record the loss in the financial statements if we can reasonably estimate the amount. Like for example, we expect a lawsuit that it might result in a loss of $1 million. We are expecting a loss. Since the amount can be reasonably estimated, so we need to, and it is probable, so we need to accrue this liability on the balance sheet and charge it as a loss to the income statement. So if the loss is probable and the amount can be estimated reasonably, then we need to charge it as a loss to the income statement. If the exact amount isn't available, we have a range, like maybe we have a range of $600,000 to maybe $900,000. In this case, we take the lower amount, this one. Reasonably possible, more than remote but less than likely. It means the loss might happen, but isn't certain like the one that we have here, probable. So like for example, a customer file a lawsuit for $500,000 and there is a 40% probability, the chance that the company might lose. Since this is reasonably possible, the probability is less than, normally the probability, if it's nearly 80 and above, then we call it that the loss is likely to occur. And anything above, anything below this is considered as reasonably possible. So what we do, we disclose this potential loss in the financial statement, but we do not accrue it in our income statement. We do not book it as a liability. And the third one, remote, very slight chance of occurring. The loss is very unlikely to happen. So in this case, we don't need to disclose it unless it's a guarantee type loss. Previously, I told you that we have given a guarantee for a loan for one of our subsidiaries or for any company. So in that case, we need to disclose it. For otherwise, remote losses are not recorded or disclosed. Like company A has filed a case against you for patent infringement, and your lawyer tells you that this is very unlikely to succeed in the court. There is just 10% probability or nearly no probability. In this case, we don't do anything. We do not record it or we do not disclose it in financial statements. Loss is probable and can be reasonably estimated. Means if the loss is likely to happen and its amount can be estimated, just I gave you the example previously, it must be recorded in the financial statements. You need to record it as a loss and disclose the detail. Like take another example. We expect to lose a legal case and we estimate that we may have to pay $10 million. See, amount can be reasonably estimated and it is probable. So in this case, we are going to book it as an expense, a loss, and since we haven't yet paid, so we record it as a liability, right? That is the first case. In second case, loss is reasonably possible. Means the loss might happen. It is reasonably possible, but it isn't certain or probable. We just disclose the details in the notes to financial statements, but we do not record it as an expense, or we disclose it as a liability on the balance sheet. So, right? So, what we may have to do, we may have to explain what the situation is about, nature of the contingency, and provide an estimated amount or range of possible losses. If exact amount isn't known, at least you can provide a range. Like we face a lawsuit and there is a, let's say, 30% chances that we may have to incur a loss of $500,000 to $1 million. So the company must disclose the situation and the estimated range in this way in the notes to accounts if it is reasonably possible.
Loss is remote means there is a very low chance of its happening. So normally we do not disclose such a loss. But if it involves some specific guarantee type obligation, then we may need to disclose. It says debts of others guaranteed officers related parties means when a company guarantees the loan of another party, of its officers or of its related parties or subsidiaries, it might become liable if the borrower fails to pay. Like let's say we guarantee a loan of $500,000 taken by our chief executive officer. So if the CEO fails, CEO's personal loan by the way, and if CEO defaults, the company could be held responsible, right? Even if the chance of default is very low, this is disclosed in the notes because we have this guarantee given. Second, obligations of customers, commercial banks under standby letters of credit. Like we need to purchase from a foreign supplier, so we go to the bank and bank issues a standby letter of credit for us for $1 million purchase, right? If we are unable to make the payment, we default, the bank pays this amount. So this remote possibility should be disclosed if we are unable to pay. Guarantees to repurchase receivables or related property that have been sold or assigned. Consider we have sold our account receivables, our trade receivables worth $2 million to a factoring company, but with a guarantee to repurchase if the collection fails. Maybe if some of the customers do not pay, let's say $100,000, they do not pay. So we have given guarantee that we will repay if the customers don't. Even if this repurchase is unlikely, but this guarantee needs to be disclosed. The loss is remote, but still it needs disclosure. Alton Company is the defendant in a wrongful death suit filed as the result of the death of an employee who was working on one of the company's production lines. The plaintiff filed suit in June and has asked for damages of $3 million. Alton carries insurance for potential claims of this nature, but the insurance coverage amounts to $1.5 million. Legal counsel for Alton believes that the judge will rule in the plaintiff's favor, plaintiff those who have filed case against us, we are the defendant, and that the company will have to pay $2.2 million, but the settlement could reach $3 million. Identify the financial statement treatment for the contingency and prepare the journal entry. Since it is probable that the judge will rule against us and the estimate is available of 2.2 million, we should report it as a loss to the income statement, and since it hasn't yet been paid, we accrue a liability. So loss debit, liability credit, but you must disclose that there could be a maximum settlement amount of $3 million and that the insurance proceeds that may result would be treated as a gain contingency, not recorded until receipt. For now, this is what you're going to report to the income statement and the balance sheet, and also disclose that the amount could be as high as this much. Yes, there can be gain contingency from the insurance company, but we won't accrue unless it's realized, because we already agreed that the gain contingencies cannot be accounted for unless they are realized or you are virtually certain that you're going to collect it. So that's the point. Now let us do it in a one go. All this is explained nicely in this tabulated form. Loss contingency that is probable and amount or range can be reasonably estimated. That's the key point. That's where you're going to accrue it as a loss and book it as a liability. So in this case, if the range is available, take the minimum, right? And you need to disclose the nature. Amount cannot be reasonably estimated. We are not going to accrue it in the books of accounts, right? And we may disclose it in the notes to accounts, the nature and the range available. Loss contingency that is reasonably possible, just disclose the nature and range. Please note, this is the only situation where we're going to accrue in the books of accounts when it is probable, as well as the amount can be reasonably estimated. Then the loss contingency that is remote, ignore. If it's remote, ignore. But if it is remote, but it's guarantee for another's, you need to disclose the nature and the range. And gain contingencies that is probable or reasonably possible, just disclose the amount and the nature. And if the gain contingency that is remote, ignore. It's a very nice table. Just go through it. I think this covers everything what we have done so far. It's a nice way to remember what is the likely treatment. Potential loss contingencies means losses that might occur if an event happens in the future, like a lawsuit or environmental liability. So if it is probable and the amount can be estimated, you need to bring it in the books of accounts. And if not, you need to disclose in the books of account. That's what we have already done. Appropriation of retained earnings. We know retained earning is a part of equity. So sometimes we reserve a part of retained earning for specific purposes, such as for a potential losses or some potential contingencies. So what basically we do, we set aside a certain amount of money, let's say $50 million, quite a sizable amount. So we simply separate 50 million from retained earning to show that these funds are set aside for a specific purpose. So within the retained earning, we show it as this is an appropriated retained earning. This is the unappropriated retained earning, and this 50 million is reported in the appropriated retained earning, and it is clearly not an expense, which is just that we have set a certain part of the retained earning aside. So this is shown as an appropriation in the equity section, and please remember, appropriations are not expenses. They are just segregated for transparency purposes, like we have set this 50 million aside for transparency purposes. Actual cost, when we actually incur, maybe we pay $45 million in actual. These actual costs, they are recorded in the income statement as an expense, right? They are not recorded or deducted from the appropriated retained earnings, just that we set this amount aside, but the actual loss is reported as a part of income statement. Restoration of appropriation of retained earnings. Once the reason for appropriation no longer exists, like if the lawsuit risk that we have accounted for $1 million, if the event doesn't happen, we are not liable for this amount. So this 1 million, it is restored to the general retained earning, or what you call the unappropriated retained earning. So please remember, if the lawsuit risk no longer exists, you simply reverse it back to the unappropriated retained earning. Premium and warranties, they are both loss contingencies, but let us first discuss what are premiums. Premiums, basically these are incentives offered to our customers to stimulate our sales, such as free gifts or discounts in exchange for coupons, box tops, labels, so on and so forth. Let's say we issue 10,000 coupons for a free gift, and it is estimated that 70% will be redeemed. So 70% of 10,000, that means 7,000 coupons will be redeemed. And let's say if the cost of each gift is, let's say $10, that means the liability recorded would be $70,000. This is the way we do it. Number of coupons issued, 10,000. Estimated redemption rate, 7 out of 10 or 70 out of 100. So the total estimated coupon redemption will be 7,000 and the cost is 10. So $70,000 liability would be recorded. The important point to note here is the estimated cost of premium is recorded as an expense when the sale occurs, when the related sales occur. And these outstanding premium liabilities, they must be estimated to reflect the future obligations. Next, we have a good example here. A AAA corporation kicked off a sales promotion on August 31st, year 1. AAA included a redeemable coupon on each can of soup sold. 5 coupons must be presented to receive a premium that cost AAA $2. AAA estimates that 70% of the coupons will be redeemed. Information available at December 31st, year 1 is as follows. 1.5 million coupons sold, premiums purchased 200,000, and coupons redeemed 600,000. Calculate AAA Corporation's estimated liability for premium claims. Now this is the cans of soup sold, and each of them is sold when one soup of can is sold. AAA estimates that 70% of the coupons will be redeemed. That means out of this 1.5 million coupons, 70% will be redeemed. That means the coupon that would be redeemed would be 1.05 million, right? Of these, this 600,000 have been redeemed so far. How many remaining? 450,000 coupons. Since it says 5 coupons must be presented to receive a premium, that means 450 by 5, that means 90,000 outstanding premium claims are there, and it cost $2. See, that cost $2. That means 90 times 2. So the liability that we need to include is 180,000. So you're going to debit premium expense and credit premium liability $180,000. Premium expense debit, premium liability credit. Then we have warranties. What are warranties? Warranties are basically a written guarantee, a seller's promise to fix a product or to replace a product that it sells, and it is of course for a stated period of time. And as per the past history, that 3% of our sales revenue needs to cover the warranty expense in the year of sale and maybe 5% in the next year. So what we do, instead of just booking 3% in the year 1 or 5% in year 2, let's say if we sell goods worth $100,000 in year 1, 3% and 5 combined, maybe let's say if there is another year, third year, we take all the 10% of estimated warranty liability, $10,000, and we bring it in our accounting records and expense and estimated warranty expense in year 1, despite it might be required in year 1, in year 2, in year 3. So the point is that when the sale is recognized, we calculate the estimated warranty expense in total, maybe for all the 3 or 5 or 10 years, and we bring it in our books as an expense for the same period. So we debit the warranty expense, credit warranty liability. We don't wait for the actual warranty to accrue. We simply take an estimate of warranty and take it as a whole as an expense in the year of sale. Take this example. ABC Corporation has a 3-year warranty against defects in the machinery it sells. When a warranty claim is made, ABC Corporation satisfies the claim by replacing the machinery. Warranty costs are estimated at 2% of sales in the year of sale, 4% in 4 and 6% in the succeeding year. That means a total of 2 plus 4, 6 plus 6, 12% in total. ABC sales and actual warranty expenses for year 1 through year 3 is what as follows. And these are the sales figure, these are the actual warranty costs. Prepare the journal entries to account for the warranty in year 1 and 3. Determine the balance in the warranty liability account at the end of the year. I'm going to give you a format that will be very helpful to help you do questions like these. This is the warranty liability account. It may have an opening balance which is debit. Every year, like in the first year, I'm going to create an estimated warranty liability account, which is 2 plus 4, 6 plus 6, 12% of this total amount. So that is 30,000. So I debit warranty expense, 30,000, that goes to income statement, and credit warranty liability. The actual warranty spending for year 1 was $10,000. That means that's the actual warranty spending. The carried on balance would be 20,000. This carried on balance goes as an opening balance for the next year, right? And next year I charge 12% of next year's sales, which will be 500,000. 12%, that will be 60,000. So that's the brought down balance. I debit warranty expense and credit warranty liability with $60,000, right? The actual warranty spending was 20, so we debit 20,000. So that is 20 plus 60, 80 less 20. Interestingly, closing balance is 60. This closing balance is the opening balance for the next year. And next year, this is the sales, and 12% of $750,000 is 90. So we credit the warranty liability. The entry is debit warranty expense, credit warranty liability, 90, and actual warranty spending was 30. So 60 plus 90, 150 less 30. The closing balance in warranty liability account at the end of the third year is 120. And the amount that goes to the income statement each year is 30 for year 1, 60 for year 2, and 90 for year 3, being 12% of 250, 500, and 750,000 respectively. Now let us match these one by one, taking a different color. Let's say take green. So the first entry we make is debit warranty expense, credit warranty liability. This is it. Warranty expense debit, warranty liability credit. When the actual spending is made, actual warranty cost, since we are going for replacement, right? So in that case, we are going to debit the warranty liability, credit inventory, because we are paying the item, we are giving the item in return to the customer. So credit inventory and debit warranty liability. Then the next year, the estimated warranty cost is 12% of 500,000, that is 60. That's the opening balance. So your debit warranty expense, credit warranty liability, warranty expense, warranty liability. Actual warranty spending is 20. So your debit warranty liability, credit inventory, same thing. And in the third year, you do the same thing, debit warranty expense, credit warranty liability. And the actual spending on warranty is 30. So your debit warranty liability, credit your inventory, and this way you do the stuff. And the closing balance, as you can see, I've calculated using the T account. That is the closing balance of your warranty liability.